Welcome back to The Explainer. Today, we're unlocking the ultimate guide to trading right alongside massive financial institutions, instead of, well, constantly getting trapped by them. We're going to break down the exact mechanics of market structure and look at the actual footprints left behind by smart money. If you want to protect your capital and start seeing the market exactly how the big players do, you are in the exact right place.
So have you ever watched a massive green candle shoot straight up on your screen, felt that absolute gut-wrenching panic because you weren't in the trade, and then you bought right at the absolute peak out of pure FOMO? And then what happens? Literally instantly, the market pulls back against you. You just sit there watching your screen bleed red, wondering what on earth went wrong. Well, I'm here to tell you, that explosive candle wasn't a signal for you to jump in. It was a setup.
Here's the hard truth that every single trader eventually has to face. You aren't just unlucky. Seriously, the market is not some series of random, chaotic events. It's a highly designed system. And right now, it's using your retail stop losses as literal fuel for institutional moves. When you jump in at the top of a breakout, you're just providing the exact liquidity those massive players need to execute their own strategies.
Okay, let's dive into this. What you're experiencing is actually called a liquidity sweep. Think about it. Most retail traders jump into a trade the exact second price breaks above a previous high. And guess what? Market makers know exactly where all those retail stop-loss orders are sitting. So they deliberately push the price past those obvious levels for one reason: to grab your stops, fill their own massive orders, and then boom, they immediately send the market in the real intended direction, leaving you completely trapped.
But here's the thing. When these institutions make their real move, they leave behind a massive clue. Suddenly, a huge, aggressive green candle prints. That explosive price action happens because big banks push the market so heavily and so fast that it leaves a literal imbalance on the chart. We call this the imbalance gap. It is the absolute, undeniable footprint of institutional money rushing into the market.
Technically speaking, this footprint is called a fair value gap, or FVG for short. Let's break this down together. It's basically an inefficient area created on your chart when institutions buy or sell with such incredible speed and massive volume that only one side of the market actually gets filled. They are in such a wild rush that they completely skip right over the resting retail orders, leaving a totally empty zone in the order book. You can clearly see the difference in market behavior when this happens. On one hand, you have balanced price action. It's slow, it moves up and down, buyers and sellers are exchanging contracts nice and efficiently. But on the other hand, you have the fair value gap, explosive, one-sided, aggressive institutional expansion. The institutions literally did not have time to fill both sides of the order book, and that creates a massive void in price delivery.
Now you might be wondering, okay, but how do I actually find this on my own charts? The secret is incredibly simple. There's just one specific pattern you need to look for: a sequence of exactly 3 consecutive candles. That's it. You find a massive expansion candle in the middle, then you look at the wick high of candle 1 and the wick low of candle 3. If those wicks do not touch, that empty space right between them, that's your gap. It just takes 3 candles to decode exactly where the market is highly likely to go next. So, identifying that 3-candle gap is step 1. But before we actually blindly trade that empty space, we have to know when a market trend is genuinely shifting in the first place. And that brings us to spotting a CHOCH, or change of character. First, the market needs to break its first key low. This is your early signal that smart money is flipping the trend. But most importantly, to confirm this isn't just another trap, that candle needs a full body close past the level.
When you see this structural shift happen, you need to pay close attention. As our source material perfectly points out, that CHOCH signal is your early warning shot that smart money is flipping the trend. And once that warning shot fires, smart money starts leaving those massive unfilled orders behind as guaranteed future entry points. That gap sits on your chart like an open invitation. They don't look at it as a missed opportunity they have to chase. They view it as their ultimate target.
And because of those unfilled orders, this gap acts as a giant liquidity magnet. You see, markets naturally seek balance. Think of it exactly like a rubber band stretched way too far. The faster the price shot away from that level, the stronger the eventual pullback into it is going to be. If you ever see a trader pointing to a chart where price drops directly into a specific zone and just bounces incredibly hard, they're playing the liquidity magnet. The price is literally just returning to settle the score and rebalance that empty space.
Now, what's really interesting about this is how we combine these gaps with market structure to actually protect ourselves from traps.
You really need to know the difference between a normal break of structure, which just means the current trend is safely continuing, and a sudden change of character. That change of character is that glaring red warning sign flashing that smart money is actively reversing the trend.
But here is the absolute critical detail where most traders fail, and I really want to emphasize this. A structural shift, whether it's a continuation or a full-blown reversal, is only confirmed if you get a full candle body close past that key level. If it's just a wick that pokes through and immediately pulls back, momentum hasn't shifted at all. That was literally just another liquidity sweep designed to grab your stop loss. You absolutely must wait for the body close.
So, the crucial point here is how we bring all this together into a high-probability system. First up, check your daily or 4-hour chart to get your overall trend bias. Are we making higher highs? Great. Then, drop down to your 15-minute or 1-hour execution time frame. You're looking for a break of structure or change of character moving in that exact same higher time frame direction. When you spot it, find the fair value gap that created the move. Place your limit order right at the start or midpoint of that open space, and, this is key, set your stop loss safely below candle 1.
Honestly, this one single set of rules completely stops you from blindly buying at the top of massive green candles out of FOMO. The smart money strategy requires one major thing: patience. You wait for a clean structural shift. You stop chasing and you let the price pull back into that fair value gap. You let the market come to you, entering safely right alongside the real institutional trend. If you know how to read these imbalances, you literally never have to chase price ever again. You simply take your seat alongside the institutions. So, I have to ask you, are you ready to stop being liquidity and start actually trading the institutional blueprint? Keep practicing this strategy, wait for the market to return to the gap, and always protect your capital. Thanks so much for joining me for this explainer, and I can't wait to dive into our next lesson with you soon.